How's it going, everybody? Smoking Cigars with Howlinblind, Muddy Slim, your 60-minute Jelly Belly Toe Jam man. Yes, it's Wednesday. It's still July the 15th. I'm smoking, this is called a Legend Rio. It's a 6x60. I love these cigars. A note to Silver Eagle, I think it's 2061 or whatever. A good friend of mine from Florida. Great cigar smoker, loves cigars. In your video, you talked that there are no great cigars for $5. $5.10, my friend. Check them out. Legend Rio. These are made by Camacho, which is one of the great cigar companies ever. I'm going to do a real quick update here. I gave you a homework assignment, folks, and to look up modern money mechanics. Now, this is a document that the Federal Reserve, who does everything with our money, they tell you how it's made, they tell you how it's spent, how it's regulated, how banks are supposed to be regulated. I want to read a paragraph from the mechanics, our modern money mechanics. This will hopefully open your eyes just a tad bit and convince you or help you understand what I'm saying is not a bunch of bullshit. This is on page 2, and it starts out in big bold letters, big bold words, what makes money valuable? And that's with a question mark. This is what it says. In the United States, neither paper currency nor deposits have value as commodities intrinsically. A dollar bill is just a piece of paper. Deposits merely book entries. Coins do have some intrinsic value as metal, but generally far less than their face value. What then makes these instruments, checks, paper money, and coins acceptable at face value in payment of all debts and other monetary uses? Mainly, it is the confidence people have that they will be able to exchange such money or other financial assets and for real goods and services whenever they choose to do so. Money, like anything else, derives its value from its scarcity in relation to its usefulness. Commodities or services are more or less valuable because there are more or less of them relative to the amount of people want. Money's usefulness is its unique ability to command other goods and services to permit a holder to be constantly ready to do so. How much money is demanded depends on several factors, such as the total volume of transactions in the economy at any given time, the payments habits of society. And that's with a comma. The amount of money that individuals and businesses want to keep on hand to take care of unexpected transaction and the foregone earnings of holding financial assets in the form of money rather than other assets. Control of the quantity of money is essential. If its value is to be kept stable, money's real value can be measured only in terms of what it will buy. Therefore, its value varies inversely with the general level of prices. Assuming a constant rate of use, if the volume of money grows more rapidly than the rate at which the output of real goods and services increases, prices will rise. This will happen because there will be more money than there will be goods and services to spend on it at prevailing prices. But if, on the other hand, growth in the supply of money does not keep pace with the economy's current production, then prices will fall. The nation's labor force, factories, and other production facilities will not be fully employed, or both. Just how large the stock of money needs to be in order to handle the transactions of the economy without exerting undue influence on the price level depends on how intensively money is being used. Every transaction, deposit, balance, and every dollar bill is part of somebody's spendable funds at any given time, ready to move to other owners as transactions take place. Some holders spend money quickly after they get it, making these funds available for other uses. Others, however, hold money for longer periods, Obviously, when some money remains idle, a larger total is needed to accomplish any given volume of transactions. Now, either go back and re-listen to what I read or download it and read it for yourself. I'm at 6 minutes. I want to read one more thing. Who creates money? Changes in the quantity of money may originate with actions of the Federal Reserve System, in parentheses, the central bank. Depository institutions, and now back to parentheses, principally commercial banks, are the public. The major control, however, rests with the central bank. The actual process of money creation takes place primarily in banks. As noted earlier, checkable liabilities of banks are money. These liabilities are customers' accounts. They increase when customers deposit currency in checks and when the proceeds of loans made by the banks are credited to a borrower's account. In the absence of legal reserve requirements, banks can build up deposits by increasing loans and investments so long as they keep enough currency on hand to redeem whatever amounts the holder of deposits want to convert into currency. This unique attribute of banking business was discovered many centuries ago. It started with goldsmiths. As early bankers, they initially provided safekeeping services, making a profit from vault storage fees for gold and coins deposited with them. People would redeem their deposit receipts whenever they needed gold or coins to purchase something and physically take the gold or coin to the seller, who, in turn, would redeposit them for safekeeping, often with the same banker. Everyone soon found that it was a lot easier simply to use the deposit receipts directly as means of payment. These receipts, which became known as notes, were acceptable as money, since whoever held them could go to the banker and exchange them for metallic money. Then bankers discovered that they could make loans merely by giving their promises to pay or banknotes to borrowers. In this way, banks began to create money. More notes could be issued than the gold and coins on hand, because only a portion of the notes outstanding would be presented for payment at any one time. Enough metallic money had to be kept on hand, of course, to redeem whatever volume of notes was presented for payment. Transaction deposits are the modern counterpoint of banknotes. It was a small step from printing notes to making book entries, creating deposits of borrowers, which borrowers in turn could spend by writing checks, thereby printing their own money. All right, I'm at 10 minutes.